Let's go ahead and start today. I want to be sensitive to everybody taking the opportunity to sit in live during your lunch break here. If you're listening locally in New Mexico, for those who may not be listening live, thank you for taking the time to listen to this. This won't be the only opportunity we will have to meet with Paul to discuss this great, what I think is a very interesting opportunity. But what I want to do very quickly is introduce Paul Mauceli from REI Energy LLC in Richardson, Texas. Today's discussion is going to be on investing in oil and gas working interests. And full disclosure, this is something that's relatively new to me, but I actually am a firsthand investor in their Fund 7 that closed in December. What we would be talking about today, Paul, correct me if I'm wrong, would be Fund 8. And this would be an opportunity, if this makes sense to you, to ask me more questions during today, and you can shoot me emails afterwards, and I'd be glad to hop on a call with you, as would Paul. There's a lot to learn in about 25 to 35 minutes. We will leave the forum open for about 15 minutes at the end for Q&A. You can also ask questions along the way, but what I want to do at this moment is introduce Paul. And Paul, please introduce yourself. Tell us a little bit about you and talk more about REI Energy.
Thanks, Eric. I'm Paul Mauceli with REI Energy and Reef Securities, which is the actually broker dealer that does all the offerings for REI Energy. REI Energy has been in business since 1987. We have participated in over 3,000 wells across the United States, both onshore, offshore, Gulf of Mexico. We primarily concentrate now in the Bakken up in North Dakota and also Northwest Oklahoma, which is where the Fund 8 is participating. So, like I said, we participated, in a lot of wells with a lot of different operators, major oil companies, major independents, and we've, like I said, focusing in the last few years on horizontal wells because they offer the best potential return for investors. There's, just to clarify that a little bit, there's two types of wells in the United States: vertical wells and horizontals. Vertical wells, you can drill unsuccessful wells, meaning they don't produce any oil and gas. So that's called a dry hole. That's the risk, one of the risk factors in a vertical well program. You don't have that risk in horizontals. All of the horizontals, by the nature of the way they're drilled, will produce. I'll be showing a little small video that'll show you kind of what I'm talking about. But that's who we are, and we've been doing partnerships with private investors, through Reef Securities since 1994. So, you ready
And
to talk to you today about it, and hopefully, like it.
and I do want to thank you, Paul, for being accessible. Quite frankly, during tax season, for a handful of clients, I was talking to them about this particular opportunity, and you can reach out to Paul after this directly as well, because again, we're going to kind of touch the surface on a lot of items here. And Paul does a really great job in much more detail to explain what's happening if this is something that's of interest to you. But I do want to thank you in advance because you took the time to meet with quite a few clients of mine during tax season to explain this opportunity. And I think, when the takeaways today are, what does it mean to be investing in an oil and gas working interest? The key investment opportunity, how you make money at this, as well as some of the great tax advantages of this particular investment, which is, I think, really unique to oil and gas. And so with that, why don't you tell us more about what it is Fund 8 looks like, and how you guys, how we can, let's learn more about this.
I'll be glad to see. The basics of what we do is that we do multiple well programs. You'll have anywhere between 30 to 50 wells in a program, and you have ownership across all 30 to 50. In the oil and gas industry, diversification is king. So the more wells you can be diversified over, the better that you're going to have a chance as far as seeing a return on your investment and the overall return, on the program. As Eric was saying, our programs not only provide cash flow, but they also have some of the best tax benefits of any type investment in the investment industry. You're able to save, depending on your tax bracket, on $100,000 investment, you're able to save $20,000 to $30,000 in taxes that you would have owed without making this investment. So what we do is we put the wells together. We do all the research, all the evaluations. The wells get drilled, and once the wells go online and start producing, about 2 to 4 months after the wells are online, we start receiving revenue, and that revenue is distributed to the investors. That's kind of the basics, and I'll do the presentation here.
And as an investor, I can attest to that. The checks we're getting each month now continue to grow as more of those wells come online.
So as you said, we energize your investments, and of course, just like Eric was talking about, and maximize your tax deductions. Just to kind of start off a little bit with the demand for oil and gas, which is going to be, in our opinions, growing through the years. Oil and gas is in a lot of things other than just gasoline. So there's going to be a big demand for it going over the next 20, 30 years. Two numbers here: the global population growth in 2037 is expected to be about 9 billion people. And for 2045, it's expected that we're going to be using 118.9 million barrels of oil per day. By 2045, it's also, in order to achieve that, they're going to need an estimated 14 trillion in oil investment required. So the demand is there. It's going to continue as we have more people, on the planet. There's going to be more demand for it, and I think the prices are going to be very steady going through, the next, like I said, next 20 years. One of the things that we'd like to start off with is, of course, there is risk in oil and gas investing. Some of the risks are, the market volatility. The profitability of oil and gas investments can be affected by fluctuations in oil and gas prices. So, investments are illiquid. It's not something that you can easy exit like the option available with stocks. So what that simply means is that you're in the investment until we exit, sell the product. It's not something you can buy and sell. There's operational exposures, drilling, production, transportation operations having, inherent risk. And then, of course, global political and economic instability can create, influence in both prices and supply chains with oil and the gas market. So those risks are there. We try to minimize the risk, as far as in in a number of ways by having the, diversification over 30 to 50 wells, all the wells producing, but you still have some of these risk factors that we really can't, the fluctuation of oil and gas prices. And that you're going to have fluctuations, but we're talking sustained, lower prices, like if the oil prices during COVID, where they went down from $80 a barrel to, $20 a barrel, and it sustained itself for quite a period of time. That's what, the fluctuations could cause. So these are some examples of the vertical wells that I was talking about, and horizontals. As you can see, the vertical wells are hitting a very small little spots. So that's why you could have one spot not be successful, another spot on that same area could be. And you see the horizontal well, the horizontal leg goes all the way through the producing formation, and then they have about 60 to 90 different stages that are opened up to that oil and gas zone, which I'm going to show you here in a video. So that's a kind of an example of the two types of wells. And like I said, these programs are all horizontal wells.
Geologists have known for years that substantial deposits of oil and natural gas are trapped in deep shale formations. These shale reservoirs were created tens of millions of years ago. Around the world today, with modern horizontal drilling techniques and hydraulic fracturing, the trapped oil and natural gas in these shale reservoirs is being safely and efficiently produced, gathered, and distributed to customers. Let's look at the drilling and completion process of a typical oil and natural gas well. Shale reservoirs are usually 1 mile or more below the surface, well below any underground source of drinking water, which is typically no more than 300 to 1,000 feet below the surface. Additionally, steel pipes, called casing, cemented in place, provide a multi-layered barrier to protect freshwater aquifers. During the past 60 years, the oil and gas industry has conducted fracture stimulations in over 1 million wells worldwide. The initial steps are the same as for any conventional well. A hole is drilled straight down using freshwater-based fluids, which cools the drill bit, carries the rock cuttings back to the surface, and stabilizes the wall of the well bore. Once the hole extends below the deepest freshwater aquifer, the drill pipe is removed and replaced with steel pipe, called surface casing. Next, cement is pumped down the casing. When it reaches the bottom, it is pumped down and then back up between the casing and the borehole wall, creating an impermeable additional protective barrier between the well bore and any freshwater sources. In some cases, depending on the geology of the area and the depth of the well, additional casing sections may be run and, like surface casing, are then cemented in place to ensure no movement of fluids or gas between those layers and the groundwater sources. What makes drilling for hydrocarbons in a shale formation unique is the necessity to drill horizontally. Vertical drilling continues to a depth called the kickoff point. This is where the wellbore begins curving to become horizontal. One of the advantages of horizontal drilling is that it's possible to drill several wells from only one drilling pad, minimizing the impact to the surface environment. When the targeted distance is reached, the drill pipe is removed, and additional steel casing is inserted through the full length of the wellbore. Once again, the casing is cemented in place. For some horizontal developments, new technology in the form of sliding sleeves and mechanical isolation devices replace cement in the creation of isolations along the wellbore. Once the drilling is finished and the final casing has been installed, the drilling rig is removed and preparations are made for the next steps, well completion. The first step in completing a well is the creation of a connection between the final casing and the reservoir rock. This consists of lowering a specialized tool called a perforating gun, which is equipped with shaped explosive charges, down to the rock layer containing oil or natural gas. This perforating gun is then fired, which creates holes through the casing, cement, and into the target rock. These perforating holes connect the reservoir and the wellbore. Since these perforations are only a few inches long and are performed more than a mile underground, the entire process is imperceptible on the surface. The perforation gun is then removed in preparation for the next step, hydraulic fracturing. The process consists of pumping a mixture of mostly water and sand, plus a few chemicals, under controlled conditions into deep underground reservoir formations. The chemicals are generally for lubrication, to keep bacteria from forming, and help carry the sand. These chemicals typically range in concentrations from 0.1 to 0.5% by volume and help to improve the performance of the stimulation. This stimulation fluid is sent to trucks that pump the fluid into the wellbore and out through the perforations that were noted earlier. This process creates fractures in the oil and gas reservoir rock. The sand in the frac fluid remains in these fractures in the rock and keeps them open when the pump pressure is relieved. This allows the previously trapped oil or natural gas to flow to the wellbore more easily. This initial stimulation segment is then isolated with a specially designed plug, and the perforating guns are used to perforate the next stage. This stage is then hydraulically fractured in the same manner. This process is repeated along the entire horizontal section of the well, which can extend several miles. Once the stimulation is complete, the isolation plugs are drilled out and production begins. Initially water and then natural gas or oil flows into the horizontal casing and up the wellbore. In the course of initial production of the well, approximately 15 to 50% of the fracturing fluid is recovered. This fluid is either recycled to be used on other fracturing operations or safely disposed of according to government regulations. The whole process of developing a well typically takes from 3 to 5 months. A few weeks to prepare the site, 4 to 6 weeks to drill the well, and then 1 to 3 months of completion activities, which includes 1 to 7 days of stimulation. But this 3 to 5 month investment can result in a well that will produce oil or natural gas for 20 to 40 years or more. When all of the oil or natural gas that can be recovered economically from a reservoir has been produced, work begins to return the land to the way it was before the drilling operations commenced. Wells will be filled with cement and pipes cut off 3 to 6 feet below ground level. All surface equipment will be removed, and all pads will be filled in with dirt or replanted. The land can then be used again by the landowner for other activities, and there will be virtually no visual signs that a well was once there. Today, hydraulic fracturing has become an increasingly important technique for producing oil and natural gas in places where the hydrocarbons were previously inaccessible. Technology will continue to be developed to improve the safe and economic development of oil and gas resources.
Anyway, these are the two types of investment products that REI Energy offers: drilling and income funds, which is what I was referring to earlier. And then we also have a new product that we've done now. We've just finished our first one, is mineral funds. This is where you're buying and purchasing the actual mineral rights to drill where the wells are getting drilled on. So you're actually a mineral right owner. We'll talk about that in a little bit more detail. But the investment highlights for our programs is that investors share in 90% of the partnership interest. Now, to put this in perspective, the kind of standard in the industry for most oil and gas partnerships has been a 75-25 split. And the investors get 75, the oil and gas company gets 25. Our deal is a 90-10, so the investors are getting 90% of the partnership interest, and Reef gets a 10% carried interest. In addition, we invest alongside the partners by purchasing 3% of the units in every partnership. So we have skin in the game on every project that we do. Another thing that we do is different from other companies is that all the wells are drilled at actual costs, ensuring no hidden or inflated charges. And what a lot of oil and gas partnerships that are, called promoted deals do is that they'll actually promote the price. So, for example, if a well cost $1 million to drill, they would charge the partnership $1,200,000 to $1,300,000. Basically, that company is making $200,000 to $300,000 off the well, regardless of whether it's any good or not. We don't do that. Actual costs. So that's a much better deal for you as an investor on our projects. Another thing that companies do is that they have subsequent cash calls where they can call the investors for additional monies after the well has been drilled, if they had some kind of issues with it or things like that. We don't have no cash calls, so your financial commitment is limited to your initial investment. So those are three differences there that I feel sets us apart from other oil and gas partnerships. The investment size is $100,000. The minimum is $25,000 on our projects, and we have an exit strategy. What we look to do is to cash flow the wells for 3 to 5 years. Then we look at selling within the fifth year. This is, of course, for accredited investors. And as in our programs, the investors have two options for partnerships, and this is kind of related to the tax benefits, how you take them from your income tax. From your taxes each year. As a general partner, the tax deductions can be used from drilling, can offset any income earned in the same year. And that's, in the same year means is that the way that the tax benefits work is that it's in the year the wells are drilled and completed. And so with a multiple well program, as Eric was talking about earlier, it's going to, these wells are going to be drilled over 2 years. They're not all going to be drilled in 1 year. So the tax deductions will be realized over kind of a 2-year period. As a limited partner, you can come in, you can still get the same type tax benefits, but you can only write it off against passive income. And this is an example of, of where we are in Oklahoma. All of the the wells that have been drilled out here is a very active area. The orange that you see here are the wells that are scheduled for REI 8. This is a blown up image of it, so you can see it a little bit better. But you can see, in the middle here where it says the Devon Cinnamon, Devon Campbell, and the Natal Gooseman Cotinga. One is says prep to spud. What that simply means is that they're getting ready to start drilling the well. Permitting is the stage before you drill the wells. You have to permit a well in order to drill it. And then you can see the Natal Gooseman is drilling or spudded, and that's the date. What spud means is when the bit starts turning to the right. That's the day the drilling starts. So that's kind of an explanation for that. Those are examples of the wells that you can see on here that the partnership has. It's going to have somewhere between, right now we've got it right at about 41 drilling locations that we have the rights to drill on. Excuse me. And there's basically 4 types of oil and gas tax incentives. The intangible drilling costs, again, Eric was referring to that earlier. What that is that's anything that's not reusable during the drilling process, such as an example would be labor. Tangible drilling costs is the depreciation. Look at it just like depreciation on real estate. So you have surface equipment, that tanks that hold the oil and gas, the heaters, things like that. So you can depreciate that through the tangible drilling costs. And that is, you're able to take some of it in the year the wells are drilled, and the rest of it you would depreciate off your taxes over a 5-year period. The depletion allowance is for producing and selling the natural resources out of the ground, and that represents about 15% of the gross income and up to 20% of the net income. And then you have lease costs. The lease are basically, you have to pay for the right to actually go out and drill the wells. So that's when you acquire a lease, you're able to drill on that lease, and there's a cost for that lease. And this is kind of an example of one of our programs. This is the REI Energy Drilling Income Fund 1. It shows, we'll show the returns, the tax incentives, and the K1 information, so you can kind of see how an oil and gas program works. So this program has 28 wells in it, as you can see here. You can see the operators of the wells. We talked about, participating with majors and major independents. You can see ConocoPhillips, Continental Resources, Hess, Whiting Oil. These companies are majors and major independents. And that's a benefit to you as the investors, because these companies have own 40 to 60% of the wells that they're participating in. That's how they are able to be the operators of the wells. And so there's 100% working interest in a well. Operators own 40 to 60%. Companies like REI Energy and individuals, anybody can own working interest, owns the remaining part of the working interest. So they have the majority of their money invested in these projects. So that just adds to the credibility of the wells being drilled. This is the cash flow that the REI 1 generated based on a $100,000 investment. One date you can see there that started producing on July 14, 2020. That was right in the middle of COVID. We actually got $21.42 a barrel in that first month. If you don't recall, in May of 2020, oil went negative for the first time in the history of record keeping. Over the first 12 months of this program, the average price of oil that we received was $42.62. And the program still generated over 20% cash flow to the investor. So on a $100,000 investment, they got over $20,000. That just demonstrates that our projects can perform in low price environments. This program, if you look to the right here in the green, it's been online now for 59 months. Total cash on cash is $96,714. Annual cash flow is average 19.67%, with the average distribution being $1,639.23 a month. So this is an example of K1. You can see the highlighted here, the under 13, the 16,728. That is basically the intangible drilling cost for that particular year. And then you see there was a self-employment loss, earnings, a loss on that year. So the total write-off is under the Z, 20,807 was the total they would be able to write off for that year.
Is there a way to expand, Paul, is there a way to expand the screen a little bit more? Oh, okay, we can see a little bit more here. Okay, very good.
So that's this is just an example of how the K1s look. I'm going to show you what we did for the first 3 or 4 years on here next. But that's you would be getting a K1 each and every year on your investment. K1s come out in February and March. So basically, as you can see here in 2019, that 20,807, and 2020. They got 45,293, and the drilling went over. Typically it's 2 years, but the drilling went over, and so in 2021 they had an additional $5,038. So that represents $71,138 on an oil and gas investment. What we talked about is that you're able to write off up to 80% of the investment. So on a $100,000 investment, that means you're able to write off up to $80,000.
And if I may,
right here.
And that to me is where the real power of this is that investment. No other investment that you make, other than potentially real estate, affords you, and this is why it's even better than real estate, quite frankly, affords you an immediate deduction that you can apply against other ordinary income. When we talk about maybe real estate, where you may have depreciation, right, that, while it may be a deduction, could be suspended because of income limits. There's no income limitations on IDC deductions. So on that $100,000 in this example, when we talk about that, maybe in a year one where there's potentially $40,000 to be written off immediately. For some people, if you're in a 35% tax bracket plus New Mexico, or state rather, where there's another 5 to 6%, you're talking savings of up to $17,000 year one on your taxes. Yeah. Plus you still get the investment. That's where the real power of this is.
Right. And then you also have, like we talked about, the lease costs. That's the second column here, and that's your cost basis depletion. So you have additional $8,475 in lease costs that you're able to write off, and that's the intangible drilling cost that's included in that. And so those two totals there, if you look down, 71,138 and 8,475 is a total of $79,613. So that represents the 79.61, like I said, up to 80%. So that's the total write-off, the total IDC and lease cost write-off that these investors, this investor received on this, particular investment. Now, we talked about in the depletion allowance, which in addition to the write-off you get from the IDC and the lease costs, you also get tax-free income throughout the program on the depletion allowance. And again, like I was saying earlier, it's 15% of the gross income up to 20% of the net income. And if you look over, on this excess of basis depletion, this program generated, $17,092 in basically tax-free income. And the upside to this is that in addition to the tax-free income, it's not subject to recapture because it's in excess of basis depletion. So if you look down at the very bottom, you see that 17,000 represents 22.3% of the received income, making it tax-free and not subject to recapture. So that's another big part of an oil and gas investment that no other investment offers. So this tax-free income is, it doesn't add to the percentage, the annual cash flow percentage, but it is very important because you don't pay any taxes on that income that you receive from this investment. So that's and that's based off the total income over the right of $76,000. Now, again, here's the calculation for the estimated tax savings. So you take the investment size times the intangible drilling costs times your marginal tax rate, and that estimated tax savings in that example there is $29,853. So you look at this, you can look at this as two ways. You can look at it as added value to the investment, but you also can look at it as a return of your capital. So on your $100,000 investment now to break even, you only need about $70,250, $70,150 to actually break even from the revenue generated by the wells. The performance highlights of REI-1, this is to show you that based on a 2-year investment, as the investors got back $70,842. The estimated tax savings generated was $29,853. So the total value delivered to investors was $100,695. So they recouped their initial investment within 26 months when they considered the cash distributions and the tax savings as a return of the capital.
Paul, we have a question from a panelist here. We talk about the IDC and related deductible costs roughly around 79 to 80%. The question from one of the attendees was, how great the potential variation from off of that 80% have you seen over the years? I can say from experience, what we saw, we're looking to be close to that 80% number. But can you comment on the variation?
Well, as far as it's like when I say up to 80%, so it could be. Intangibles, like I said, anything that's not reusable.
Yeah.
So if every well that is drilled, you have a drilling, plan for it, meaning, it's all based out as far as on the expenses. And it's also on how long it's going to take to drill. So let's just say that you have a well that is projected to drill 45 days. And, the labor for that 45 days is expected, to be a certain amount. If that well goes over, if it takes longer to drill, which, you can have issues when you're drilling a well that can cause it delayed and, take longer, then you would have more intangible drilling costs in that example. If you drill a well in less time than what is expected, then you would have less labor on there, less cost. So basically you would, have less intangibles. But I'd say that the intangibles have always, been in the range of, 65 to, 80%. You're able to write 100% of the intangible drilling cost off. That's, never changed. And what it represents basically is about 70 to 80% of the investment. Up to, like I said, up to 80%. So
the other research
it depends on the wells you're drilling, how deep they are, whether you're re-entering a well or whether you're drilling, deep horizontal wells. All those numbers can vary. What our program is, said on these types of programs, this is kind of what we're looking at.
Yeah, and I can say from the other research I've done over the last 6 to 7 months is that the standard benchmark tends to be right around 80% from
Yeah.
all different sources that I've done research on as well.
Yeah. And that's why I showed that example there. Those are actual all K1s,
Hmm.
amounts. I didn't show all the other K1s, but, we'll just show you the chart to where it was in there. So, um, and like I said, these, if we can go back here. So just to show you, the 2087 was realized in 1945 in 2020, actually 46. And then in 2021, you had 12 when you take the 5 and the 7400. So that's how it's broke up. And, it's in the year the wells are drilled and completed. And so, like I said, with a multiple well program, you're going to have some drilled this year, some drilled next year. And in the case of REI 1, you had a small amount drilled in 2021. So that's kind of how it works. If you were participating on one well and you drilled that well, then you could realize the entire write-off in 1 year. But that would typically lead you to not being on a successful well, or you could have you just don't want to participate on single or one or two, three wells. You want to have multiple wells.
Right, right. And I could just let you know from my personal experience that Fund 7 appears to be looking like it's going to be close to 76, if not 78%. But I'll only know the balance of that when we get next year's K1.
Right.
Yeah.
Yeah, we had on 7, we got, I think, around 35, 36% last year. So,
Yep. Yep.
They'll have, and they've gotten a majority of the wells have been, drilled this year. So, it definitely will be in that range. And so over the last 5 years, the total distributions have been 96,714, which I showed you earlier, same tax savings. So the total value delivered to investors is 126,567 on that particular program. And this program, we're going to be looking at, selling it at the end of this year. Prices recover a little bit from where they've been. So, then the investors would get a lump sum of whatever the sales proceeds. Like I was saying earlier, the investors get 90% of the proceeds. So they get 90% of the distributions and they get 90% of the sales price. So what we look for in our investments, which I'll show you here in a second, is somewhere between, with our new investments, around 2-to-1 to a potential, maybe 3-to-1 potential. And this is a snapshot basically of all of our, programs that are similar to the multiple well, horizontal well programs. So the first one we did is, with the Archer partnership, you see at the top here, the investor capital was $1,394,210. The total distribution and sales proceeds was $2,603,473. Months of, the total months that we had that was 72 months. The annual cash flow per year, 19.9%. So on a $100,000 investment, they were getting cash flow from the wells right at $20,000 a year. The sale was a total return of a 1.87-to-1 return. So on a $100,000 investment, they got back a total of $187,000. That does not include the estimated tax savings. That's strictly cash on cash. So they made an $87,000 profit on their investment. And you add in the tax savings, which is another 20, 30,000, then you'd have the kind of the total that they, received. And so then you go down, for the partnerships that we still have open, or that are open. The 219, the one we just talked about, 2, 3, 4, 5, 6, and 7. So these programs, if you look over to the annual cash flow, they're averaging 15, 19, 12, 13, 15, 9, 22, and 2.9. I'm going to talk about the 5 and and the 7 here. The 7, just getting started, but the 5, just to kind of show you down here at the bottom here. This program, the first 11 distributions were kind of hampered by limited acreage ownership. When you buy, purchase these wells or the rights to participate, you're buying acreage to determine the working interest that you have. One of the things that we do is that we spread our investors' money over as many wells as we buy small percentages of that working interest. And what we did with this program, this was our first venue into Oklahoma. We purchased a number of wells from another company, and the first 25 of those had very small ownership. So even though the wells produced as anticipated, we didn't see as much revenue from them because we had small ownership. So the program averaged around 3.18 annual cash flow over those first 11 distributions. But then what we did is that we started acquiring larger acreage positions to expand the portfolio with 21 additional new wells. And since not all those wells are in pay status yet, meaning where we're receiving the revenue from them, but that change has boosted the performance. That the last 10 distributions have been averaging 16.36%. So that's an example kind of how the programs start out, and the REI 7 is starting out the same way. Starting out, the cash flow is going to start off small, then it starts building as you have more wells online and producing. And this is the example of the 5. So you can see the cash flows, in the first 11 months, kind of what they, averaged. And then you can look in the yellow highlighted area where you can see that the cash flow started increasing as these, new wells that we had larger ownership. And so over the last, 10 months, again, these programs have averaged 16.36%. And then REI 6, which is currently averaging right at 22.31%, the same thing occurred with this that is occurring with 7. In fact, it's very similar. The first 4 months were basically interest payments. We started receiving some of the revenue from the first well in July, and then from August to May, the program has averaged 29.9% average cash flow. And that the annual cash flow on this program is 22.31%. Average distribution per month is $1,859. So that's kind of two kind of, snapshots of how programs can start off as far as cash flowing, and then, build up as more wells, come into pay status and things like that.
And Paul, at this point, I want to say we've got about 15 minutes left to be sensitive to people who need to get back to seeing patients and clients at 1 o'clock. And of course, there have been a few questions that have come in, but I do want to make sure that if there's any other questions or anybody have any, that take the time now, please ask any questions you have of either myself or Paul, just so that you can learn a little bit more if this is something that is of interest to you.
One popped up there, said, are there any recapture? Yes, there is recapture, but the way the accounting is done on oil and gas is that there is recapture, but it's it's much smaller amount than you would just look at it as a straight, like I said, if you made this amount of profit, the recapture is going to be this amount. With the accounting of oil and gas, it is definitely in the benefit of the investors. And so, to answer your question, yes, there is some recapture, but as you saw in that one example, anything in excess of basis is not subject to recapture. So that's one example of not having to be subject to the recapture.
And another way to mitigate the recapture cost, if you will, is to consider this as a potential ongoing strategy. Maybe not every year, but maybe every alternative year, or maybe every third year, and especially in the year where maybe an exit may occur, that doing the recapture and recognizing recapture in the year you do another investment is another way to mitigate that liability
Right.
as well.
Right. And one person asked about the $100,000 investment as a minimum. The minimum is 25,000. We sell units. This is typically a $5 million offering. We sell 50 units at 100,000, and we sell down to a quarter unit.
And there's a question here about New Mexico, or how saturated is the new drilling market? Will we run into issues not being able to open enough new wells?
What's the question?
How saturated is the new drilling market? I'm not quite sure what you mean by new drilling market.
We're producing more oil and gas. We have been in the last 4 years than we ever produced previously. Previously, the federal leases, what Trump was talking about is the federal leases that the Biden administration shut down some of the purchasing and drilling on that. The majority of the oil and gas in the United States comes from private leases. So the reopening the federal leases is not going to affect our production. All of this is on private leases. And the majority, like I said, of drilling is in the private. So it's not going to affect us as far as that goes.
When you say earlier pricing to be steady over a 10 to 15 year period in the future, I really didn't pay much attention to the price of oil per barrel up until maybe these last couple of weeks, where I think it dropped to under 60. Is under 60 where you start getting nervous, or is all your past performance, is there kind of an average price point per barrel that we could be thinking about, saying, okay, at $70 this makes sense, and yeah, that's where we typically are? Or is it at $60 where this is still making money and we're still good?
Yeah, well, the lifting cost, the actual cost to get the oil and gas out of the ground, is in the $35 to $40 range.
Okay.
So that's kind of the break even. The prices that you've seen have been dropped recently has a lot to do with some of those geopolitical deals, Trump's tariffs, scare, and also OPEC, talking about increasing production, things like that. But those things are going to settle down, and prices are going to stay. I think is going to start coming back, and we're hoping at least that you get oil back in in the $65, $75 range. Yes, we can make money. That's why I showed that on the REI 1, is that, and that started cash flowing right in the middle of COVID. First year we averaged $42.62 a barrel. The oil prices did go up to 60 in that 12-month period, but the first few months it was in the in the 20s and 30s. So it still generated over 20% cash flow. So
yeah,
the programs can perform in low price environments. Now, definitely you want higher prices, so you make more, but not going to get worried unless you get oil down in the $30, $40 range.
Okay.
And it's not you lose anything, because you're just not going to make as much at the lower prices. Once the price of oil and gas comes back, then you start receiving the higher cash flows.
Is the Paramount series Landman required watching for anybody interested in investing in working oil and gas interests? Because that was a question that came up.
No, it's not. You're welcome to watch it, but it's not a required watch or required read.
And it's not nearly as dramatic as the real life, and not nearly as dramatic as the Hollywood presents it to be.
Yeah, Hollywood's great, and but a lot of the stuff they kind of exaggerate a little bit. So
Sure. Yeah. So,
not that it's
I appreciate the questions, and I appreciate everybody's time. And to summarize, the question was about $100,000 as the investment. We use that, I think, just because the math becomes simple. But to your point, you can sell in increments of $25,000,
right.
I guess, interests, if you will. The 100,000 just is easy math when we go through these examples. So again, on a $100,000 investment, in full disclosure, that's what Cheryl and I did last year. But the potential rate of return on that, once all the wells are up and running, which I'm beginning to see now in the checks that we're getting on a monthly basis, that they continue to get larger and larger and larger as more wells come online. But once all wells are online, that $100,000 investment should yield somewhere between $13,000 to $20,000 a year, right? 13% to 20%. And if we let's just talk again at a 20% rate of return, again, because that's a nice number and potentially easy math. That $20,000, of that 20,000, you talked about this, but I want to remind everybody about this. There's a concept called depletion, and there's a depletion allowance. So on that 20,000, 15% of that comes back to you tax-free. So
Right.
on 20,000, we're talking about $3,000 coming back tax-free. You're only paying income tax on the remainder, which is really nice. Plus, also on that $100,000 between years 1 and year 2, we have this opportunity to write off about 80% of that initial $100,000 investment. And depending upon the tax bracket you're in, we're using 35%. That could be a combined federal and state. For some folks on the call, we're looking closer to 41% between federal and state. There's significant tax savings as well in year 1 and year 2. And the nice thing about this in particular, because as business owners, we have the opportunity to buy equipment, to use different types of retirement plan options to potentially reduce tax burden. But for many people on this call, they're high W-2 wage earners. And so if you're just simply a W-2 wage earner, this is also powerful because it also reduces that W-2 wage income. We can offset that income that you otherwise typically don't have much you can do against your W-2 wages. So this is and this is all in the tax code. This is not something that hasn't been tested. This has been part of the tax code since the early 80s, and through all administrations, very pro-Republican, very pro-Democratic. These rules have not changed at all, and nobody would expect in today's administration for there to be anything other than potentially improvements to that. But I haven't seen anything coming out of the current administration that they're doing anything more. But nothing at the moment is at risk.
Yeah, the intangible drilling cost and the tangible, all that was to encourage domestic drilling. Been around, like you said, for a long time. But back to your 20%, cash flow. That's why I showed that 6. We funded it at the end of 2023, and most of the drilling was done in 2024. And you can see that program's already averaging over 22.2% cash flow. And the last, few payments has been right at 30%. So that's an example of how the programs are designed to do. We expect, we're hoping that that's going to occur with 7. We're expecting that, to also be with 8. So.
Well, thank you, Paul. I appreciate it. And I'm looking here. It doesn't look like we have any more questions. I'm thankful for everybody who was on the call, everybody who sat through this presentation. So, Paul, at this moment, should anybody be interested, I guess we could do one of 2 things. You can give your contact information, or quite frankly, I wouldn't mind if people reached out to me, so at least I can anticipate, coming into next tax season or conversations over the summer about what this may mean to your planning. I would say we could do, ideally, email me first, so I know you may be of interest. And then Paul's really been generous with his time to go through these presentations in much more detail, where I think people have maybe more inclined to ask questions that they may not want to ask on an open forum here. but Paul, why don't you give us your contact information just so folks can know anyway?
Sure. Paul Mauceli, REI Energy. My direct line is 214-379-8555. My email address is paul at Reef, REEF as in Frank, S as in Sam, I as in Indian, Paul at reefsi.com.
Wonderful. And
One
again,
person asked here, what's the typical life cycle in the terms of oil and gas investment? That's what we showed, the lifespan of these wells are 25 to 30 years. We look to exit in the 5th year. Again, there's no readily, available market out there. So if we don't sell in the 5th year, then we would continue to cash flow the wells into the 6th year and try to sell it again that following year. So that's kind of we have an exit strategy, but again, the wells have very long life, so they'll continue to produce as long as we, retain them. And when you do, get in touch with Eric, what I'll do is I'll send you out the offering documents. I'll send you out an overview that kind of explains, things in more detail. It's in shorter format, and then we can talk about it.
Wonderful. Yeah, and there are some things on there that I would like to talk to clients about if they are interested, as well as you would know as well, Paul. What are the right boxes to check? And that's in the weeds when somebody's really interested, to make sure you're able to take advantage of those losses immediately. But I think with that, thank you so much. And it looks like you had the other presentation on mineral interest, which I'm also very interested in learning more about, and we could set that up for a separate call as well.
Yeah.
And I appreciate everybody listening, and thank you for the kind words, and thank you for taking the hour of your day here to listen to us. And again, anybody who's going to listen to this on the recording, feel free to reach back out to me, and I will gladly make the more formal introduction to Paul should you be interested. So with that, everybody have a great day. Thank you so much for your time.
Appreciate it. Thanks.
Bye-bye.